If I offer you two options, you can earn 30% per year or you can earn 15 per year. Which one would you choose? Most people say 30. And most people stay broke because they don't understand one simple thing. It's not the percentage that makes you rich. It's how that percentage compounds over time. Today, I'm going to show you why 30% can be a trap and why 15% can quietly build real wealth. And if you're serious about building capital the right way, subscribe to this channel right now. I publish every single day. This is a practical business and finance university. Also, in the description below, there is a free webinar where I explain the full wealth building system step by step. If you really want to go deeper into investments, start there. I'm Ravi Gabbis, and welcome back to the Gabis Show, where we unlock the secrets of real wealth in the United States every single day. Today, we're going to talk about investments. Yesterday, I told you that now I use long-term strategies with moderate returns, but I rely on compound interest. So today, let's talk about interest itself. There are two main types of interest, simple one and compound interest. If we circle back to the axis of the money kaleidoscope and look at the investor axis, an investor usually gets a return on their money. That return is expressed as a percentage. Now, simple interest is what most people understand as ROI, return on investment. For example, you have a bank account and you earn 5% per year. That means your ROI is 5%. Or you buy an apartment for $1 million and rent it out for $5,000 per month. That's $60,000 per year. So your ROI is 6%. ROI is usually measured on an annual basis. It can also be ROMI, return on marketing investment, ROE, return on equity, ROA, return on assets. For example, you buy a house 10 years ago for $100,000. Today it's worth $350,000. Your gain is $250,000. That means your total return over 10-year period is 250%. If you divide 250 by 10 years, you get an average simple return of 25% per year. Not bad. But here's the key idea. The miracle doesn't happen with simple interest. The miracle happens with compound interest. What is the difference? With compound interest, you do not withdraw the profit. You reinvest. For example, you invest $100 at 5%. After 1 year, you have $105. Now you do not take the $5. You reinvest the full $105 again at 5%. At the end of the second year, you have about $110.25. Now that amount continues working. Then it becomes $115.76, then $121.55, and so on. The investment is always added to the principal, and your principal keeps growing. That is the difference. Now, let me give you a real-life example from my own experience. When I started investing in real estate, I also had a microfinance company, and I was earning around 36% per year in that business. It sounds fantastic, but it was not easy money. I had to take collateral, I had to sue borrowers, I had legal problems, I had stress. The return was around 36%, sometimes even lower. Then I went to a brokerage company in my city. It was a serious company. They gave a presentation about their mutual funds. They showed graphs that demonstrate 300% growth over the 10-year period. And they said, on average, this fund gives 30% per year. And I remember thinking, what am I doing with this complicated microfinance business? Why not just put money here and earn 30% without headaches? But that's a trap, because 30% on average doesn't mean 30% compounded every year. That's the trick. Let's compare. If I earn 30% per year and I reinvest everything, my money doubles roughly every 2.5, 3 years. So year 0, 100, year 3, 200, year 6, 400, year 9, 800. That is 700% total increase in 9 years. That is the power of compound interest. But those brokerage presentations often show cumulative performance, not true annual compound return. When I went home and calculated properly, I realized that their so-called 30% average was actually closer to 12 to 13% compounded annually. That is a big difference. And that's why you must understand how compounding works. Brokerage companies want customers. They want investors to bring money. So they show beautiful charts, but the real magic is not the percentage they say. The real magic is compound growth over time. If you can earn 15% compounded annually for a long period, that is very powerful. If you can earn 18%, that is excellent. 20% compounded over decades, that's wealth creation. But you must understand how to calculate it. Otherwise, you can easily be misled by marketing numbers. Compound interest makes you rich. Simple interest looks good. Compound interest builds capital. And again, if you want the full structure of how business income turns into investment capital, the free webinar link is in the description. Start there. That's enough for today. Tomorrow, I'll show you a very simple mental formula to calculate compound growth quickly. See you tomorrow.